I think a reason not to trust it is we're in the middle of an historic economic shutdown, and apparently on the upside of that shutdown, and nobody's ever seen this kind of thing before. We hadn't seen 20 million people lose their job in a single month, and we really had no idea how the jobs would come back. All of the other indicators that we were looking at suggested there would be massive job losses. And it's well to put that into perspective. Remember, the forecast was for minus 8.3. It came in 2.5. So, folks, you can do the math at home on both sides of the zero line. It's nearly 11 million jobs is the number that the consensus was off by. And Wall Street was off by it a bit, too, if you don't mind my saying, because they had a nice rally when they realized that maybe we're going to be coming back sooner than we thought. Look, it could be low response rate. It could be a bias towards firms that were existing and reporting. Or it could just be that we had two things happening, Melissa. We had the reopenings happening, especially in places that may not be so well observed by people on Wall Street. That could have added a bunch of jobs. And plus you have the PPP, which caused people to bring back their workers in order to get their loans forgiven.
Steve, thanks for being here and staying up late with us, as they say. I mean, you know, typically you get in situations like this, in environments like this, you'll get the numbers will be recalibrated on the next iteration. Sure. But my point is, or I guess my question is, does it even matter? I mean, this is one of those things where the headline is on the front page of the New York Times, and the recant could potentially be on page 6 of the third fold. My point is, will people take in that consideration if, in fact, it is recalibrated?
You know, I've always wondered when the market trades the truth, because in a funny way, this is always the case, Guy. You have a number that comes, and this number is going to be revised next month. It'll be revised the month after that, and it'll be revised in about a year's time as well. So we'll find out what really happened. And in the fog of this shutdown, you can imagine there's a lot of things happening that we're unaware of and that will come back and be revised. I do think, though, you know, my basic view of life, for what it's worth, is that markets reflect economic fundamentals, and over time the economic fundamentals come out. And if we are indeed bringing back workers, look, there's a lot of things to square here, and I'm coming on here not knowing the answers to these things, but having spent the day trying to figure it out. You had something like 12 million jobless claims between the reporting periods of the two jobs reports. We don't know what happened to those. It may be that you had 12 million jobs plus the 2.5 million, which means you had 14.5 million hiring. That may have happened. We are looking very closely at high-frequency data. None of this high-frequency data suggested to us that there was going to be a massive increase in jobs here. So it's a puzzle, but these are historic times, and we just sharpen our pencils and go back and do it again.
Hey, Steve, it's Dan. Hey, quick one. You know, at the bottom of this press release this morning, the business and labor statistics, there's a note about what seems to be a miscalculation in the May numbers, and they're talking about a large number of workers who are classified as employed but absent from work. Yeah. They go on to clarify that number, and they suggest that if the miscalculation, it could have been 3% higher as far as the unemployment. So maybe the economists weren't as far off as the headline reads.
Well, no, they weren't. I will say that happened last month, where I believe the error was estimated to be around 5 percentage points. So, yeah, it would be 3 percentage points higher to 16%. But fundamentally, I'm not sure that matters much. My guess, and you guys will tell me if I'm right about this, the market really cued off the payroll number. The 2.5 million was the number people were watching. The unemployment rate is terrible. By the way, it remains well above the great financial crisis as well, quite a bit. The numbers are still terrible. I will tell you this. There's two ways to look at this if you want to play a little alphabet economics. On the one hand, what you have is you have a V-shaped recovery in job growth. You went down 20 million, you came up positive 2.5 million. But overall, it's still an L. And I'll show you why. If you look at it, we're down 20 million, we got back 2.5. So it's just 11%. There's still a very long way to go. And I don't think anything of that really changed today. There's still a long way to go. I think the market is now saying, you know what, it's coming back faster than we thought.
No, nothing changed today, Steve and folks. But I think, first of all, if you think about the extraordinary size, there's never been a larger forecasting miss than this number. And it tells you where we are in terms of where forecasting can be in the next 3 to 6 months. We have zero understanding. The underemployment rate, Steve, too. I think this is where you're getting at. The U6 is 22% or so. So, the other side to all this, though, it seems to me, is that you've got a Fed that we now know stuck around too long. And I think, Steve, you're always very thoughtful. I wouldn't say you're always defending the Fed, but I think you're thoughtful on where monetary policy has had to, be stickier. But we're often very frustrated on fast money, talking about how the Fed has overstayed their welcome. Well, I mean, no matter what happens now, I don't think this Fed's going anywhere. And therefore, markets are saying, we kind of get this. We've seen this before. And therefore, it almost doesn't even matter what the economics are.
This almost goes to, Steve, the point that you had made earlier when we were chatting on Power Lunch today, and that is the data show, no matter how flawed you think this data is or how valid the 2.5 million jobs added you think is, this shows you that it's working, that the stimulus measures that have taken over, everything that Fed has done, everything that Congress has done is sort of working, and maybe it'll buy us some time. And maybe Wall Street is believing that enough time is being bought to get us to the other side, and that's what this rally is about, maybe not necessarily about 2.5 million jobs actually being added.
I don't really have I have a lot of sympathy for traders today. I'm not quite sure what you're trading on. I looked at the percentage of the S&P 500 that has no earnings guidance. And I think what you're trading on is a broad structure of a rebound. And my best guess is that structure of that rebound is divorced from the high frequency idea of, is it coming back today, tomorrow, or next week? You guys who have to, not you guys, whoever of you is long the market has to be in with both feet and saying it's coming back, and it's coming back to a reasonable place. And in the time before it comes back, I've got all of this support from the Fed, as Tim suggested. There's a question now whether or not we get additional congressional support, because I think this jobs report makes that a little bit less likely. I'm not really sure where Congress is going to be on Monday after this number. You could imagine some Republicans would be less likely to endorse that. But right now, the game is this: it's going to come back. We're going to end the shutdown. We're going to end the social distancing, and Congress is going to, and the Fed are going to bridge us to that place.
Yeah.
And that place could be 6 months from now, or it could be 4 months from now. But I don't think you care on that, because if you're playing for next month, I don't know what to tell you.